There's a token called HYPE that's quietly become one of the biggest stories in crypto this year. The 10th largest crypto asset by market cap, a spot ETF that just launched on the NYSE, and Coinbase building official stablecoin infrastructure around the protocol. The thing it sits on top of is called Hyperliquid, and it's worth understanding for one reason in particular. It's the most successful test yet of whether a decentralized protocol can actually match centralized exchange performance on the things traders care about. Quick context first. A DEX is a decentralized exchange, a protocol that lets you trade tokens on-chain without an intermediary holding your assets. Most DEXs trade spot assets, swap one token for another, using pools of liquidity called automated market makers, or AMMs. Hyperliquid is a different kind of DEX. It's built specifically for perpetual futures, leveraged contracts that track an asset's price without an expiration date, and it doesn't use AMMs. It runs a real on-chain order book, the same kind of bid and ask matching that powers centralized exchanges like Binance or Coinbase. That distinction is the entire story. Here's why it matters. On-chain order books used to be considered impossible. Order books require thousands of small updates per second, placing bids, canceling them, matching trades, and most blockchains simply can't process transactions fast enough or cheaply enough to support that. So on-chain trading went a different direction. AMMs let you trade against a pool with a single transaction. The trade-off is worse pricing for big trades, no leverage by default, and a user experience that traders coming from centralized exchanges find clunky. Hyperliquid's answer was to not use a general-purpose blockchain at all. Instead, it built its own Layer 1 from scratch, with a consensus mechanism called HyperBFT, designed specifically to support the latency and throughput and order book needs. The book lives on-chain, the matching engine lives on-chain, but the chain is fast enough that the experience matches a centralized exchange. That bet, build the chain to fit the use case, instead of forcing the use case to fit the chain, is why everything else works. And the numbers are real. In 2025, Hyperliquid logged nearly $3 trillion in trading volume. That's the kind of volume that rivals Tier 2 centralized exchanges, on a protocol that didn't exist 3 years ago. The HYPE token, native to the chain, launched via airdrop in late 2024 and now sits as the 10th largest crypto asset by market cap, worth over $11 billion. What's been happening in the last week is what makes this video timely. On May 15th, Bitwise launched a spot HYPE ETF on the NYSE under the ticker BHYP. It's the first US-listed Hyperliquid ETF, and the first crypto ETF anywhere to stake the underlying asset in-house, paying staking rewards through to shareholders. The day before, Coinbase announced it's becoming the official treasury deployer of USDC on Hyperliquid. In practical terms, that means USDC, already at around $5 billion of supply on the network and growing, gets deeper integration, and Coinbase is sharing the majority of the reserve yield back with the Hyperliquid protocol. Circle, the company behind USDC, is also staking 500,000 HYPE toward becoming a validator. Each of those would be a meaningful announcement on its own. Inside 1 week, they collectively say something specific. Institutional infrastructure isn't just integrating with Hyperliquid the way it once integrated with Binance and Coinbase. It's building inside it. One thing worth being clear about, though, Hyperliquid runs on its own validators, a smaller set than a chain like Ethereum or Solana, which means censorship resistance and decentralization look different than they do on those networks. The HLP vault, where users can deposit USDC to provide liquidity to the Perp markets and earn yield, is also exposed to losses when traders win against it on average. And the HYPE token itself is governance and protocol economics. Owning it isn't owning a share of trading revenue directly, and the value depends on what holders believe about the protocol's future direction. The growth is real. The risks are real. Read what you're holding. The architectural bet Hyperliquid made was that the best way to build a DeFi version of a centralized exchange wasn't to compromise on user experience, it was to build the chain around the experience. 2 years, and nearly $3 trillion in volume later, with institutional ETFs and stablecoin infrastructure stacking on top, That bet looks like it paid off. Centralized exchanges aren't going anywhere. But they now have a real on-chain competitor, with the transparency and self-custody of DeFi. That's a category that didn't exist 3 years ago. Hyperliquid is the one that proved it could. That's Hyperliquid. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.